At Regent Financial, we pioneer the future of structured finance by seamlessly integrating sustainability into advanced securitization frameworks. Our ESG-linked tokenized synthetic securitizations redefine how capital flows align with environmental, social, and governance objectives, while delivering superior outcomes for issuers and investors alike. We leverage cutting-edge derivative pricing algorithms and stochastic risk modeling to construct synthetic tranches that capture precise exposure to ESG-linked assets. These derivative pricing algorithms are designed to handle the complexity of structured products by incorporating multi-factor models that account for underlying asset dynamics, interest rates, volatility surfaces, and market correlations. Techniques such as finite difference methods, FDM, Monte Carlo simulations, and backward induction through binomial and trinomial trees are employed to compute fair values of bespoke derivatives embedded in synthetic tranches. Moreover, advanced stochastic models such as the Heston model and the Cox-Ingersoll-Ross (CIR) process are integrated into the pricing framework to capture realistic market behaviors, including stochastic volatility and interest rate shifts. These models allow us to compute more accurate prices for path-dependent payoffs and contingent claims. Bespoke tranche structuring is at the core of our offerings. By dynamically collateralizing synthetic exposures and embedding multi-level risk waterfalls, we unlock new financing possibilities while maintaining robust credit risk analytics. This approach facilitates efficient capital allocation to green and socially responsible projects. Stochastic risk modeling forms a crucial part of our structuring process. Using a combination of Brownian motion-driven models and jump diffusion processes, we assess risk dynamics over time and under extreme market conditions. Mathematically, these models are based on variations of a general stochastic differential equation, SDE, including asset values, a drift component, volatility, and random fluctuations represented by a standard Wiener process, and a Poisson process modeling the arrival of jumps. The inclusion of jump diffusion components allows us to capture sudden market shocks, making our risk models more resilient and predictive. Blockchain tokenization transforms the securitization landscape. By representing synthetic tranches as digital tokens on decentralized ledgers, we enhance liquidity, fractional ownership, and tradability of ESG-linked exposures. Each token embodies a programmable security, governed by immutable smart contracts that enforce terms and conditions, automate payment flows, and enable real-time settlement. Our blockchain-integrated frameworks provide unparalleled transparency, enabling stakeholders to track ESG performance in real time, while securing transaction data with cryptographic integrity. This decentralized ledger approach strengthens investor confidence and aligns with emerging regulatory mandates. Mathematically, we model risk exposure by decomposing asset dynamics through stochastic differential equations, SDEs. These equations describe how ESG-linked asset prices evolve over time under both systematic and idiosyncratic shocks. Incorporating ESG factors requires extending and to account for exogenous sustainability drivers, such as carbon price indices or social impact metrics. The covariance structures among ESG-linked assets are optimized using advanced copula functions. These functions model complex dependencies beyond simple linear correlations. For instance, a Gaussian copula may describe moderate relationships, while a Clayton copula captures stronger tail dependencies, ensuring resilience under stress scenarios. Advanced Monte Carlo simulations underpin the pricing of path-dependent payoffs and sensitivity analyses. These simulations involve generating thousands of potential future scenarios for ESG-linked asset values based on stochastic processes. The goal is to model the entire distribution of potential outcomes, allowing us to compute accurate tranche prices and identify key risks. Formally, Monte Carlo methods approximate expected values. Independent random samples are generated from the distribution defined by the SDEs, and the payoff function of the synthetic tranche is derived. By incorporating path dependencies, these models capture the cumulative effect of ESG factors and market shocks on tranche performance. Predictive credit risk models are integral to our structuring process. Using machine learning algorithms such as gradient boosting and neural networks, we forecast potential credit events by analyzing both macroeconomic indicators and ESG-specific data. These models output forward-looking default probabilities and loss-given default metrics, which are essential for tranche risk calibration. Additionally, dynamic risk scoring adjusts exposure ratings in real time based on new ESG data feeds and market movements. For issuers, Our ESG-linked tokenized synthetic securitizations offer a compelling proposition: lower funding costs, capital efficiency, and reputational enhancement in ESG-conscious markets. Investors benefit from superior yield generation, driven by dynamic risk transfer mechanisms and correlation analytics that optimize exposure across hybrid asset classes. Blockchain-enabled tokenization further amplifies yield potential by reducing frictional costs and unlocking secondary market liquidity. Our hybrid securitizations bridge traditional and synthetic exposures, creating resilient structures that diversify risk while maximizing liquidity. The inclusion of blockchain tokenization ensures secure, tamper-proof execution of payment waterfalls and collateral management processes. By embedding real-time analytics and leveraging predictive credit risk models, we deliver robust frameworks capable of adapting to volatile market conditions, securing a competitive edge for both issuers and investors. Regent Financial, leading the transformation of structured finance. Redefining capital markets with ESG-linked tokenized synthetic securitizations, designed for sustainable growth and superior financial outcomes.